A new monthly briefing has been released covering the first week of January 2026, and according to the report itself, its timing is intentional. The briefing opens amid heightened volatility in the silver market, where prices have been moving sharply and unpredictably in recent trading sessions. At the same time, public commentary surrounding silver has increasingly suggested that the market may have reached a peak. However, the briefing states that while this public narrative focuses on price charts and short-term technical movements, conditions in the physical silver market are presenting a different set of signals. According to the briefing, a divergence has emerged between paper pricing and physical market pricing for silver. The report notes that in at least one major overseas market, buyers are paying materially higher prices for physical silver than those reflected in certain paper markets. The briefing describes this difference as a measurable gap rather than an abstract concept and emphasizes that such gaps have implications for market mechanics. The report frames this discrepancy as a structural issue rooted in how different layers of the market function, rather than as a short-term anomaly driven by sentiment alone. The briefing explains that its objective is to distinguish between measurable data and what it characterizes as theatrical or noise-driven market commentary. It states that rather than focusing on daily price fluctuations, the analysis concentrates on pricing spreads, supply conditions, and capital movements. The report describes scarcity as a recurring theme and states that scarcity is no longer presented as a theoretical concern, but as one that is increasingly visible through pricing behavior, premiums, and shifts in capital allocation. The briefing further asserts that public-facing narratives often emphasize technical chart patterns, while underrepresenting developments in supply chains and policy-related factors. The report identifies what it describes as a growing problem of misinformation within financial media and online market commentary. It states that misinformation does not always appear as outright falsehoods, but can also take the form of selective framing or omission. According to the briefing, this environment can create confusion for market participants, leading them to question the reliability of individual data points, while broader market movements continue regardless. The report argues that treating all market commentary as equally authoritative can obscure meaningful signals, particularly those that emerge outside of short-term price action. Within this context, the briefing states that silver is currently undergoing what it terms a period of price discovery. The report clarifies that price discovery refers to a process in which market prices adjust amid competing pressures, including paper liquidity and physical supply constraints. It notes that recent trading sessions have been marked by elevated volatility and describes this volatility as a factual observation rather than a conclusion about market direction. The briefing explicitly states that volatility alone does not establish that a market top has occurred, and notes that repricing phases are often characterized by irregular and unstable price behavior. The report explains that in such conditions, traditional chart-based analysis may appear inconsistent or confusing, particularly for observers who have not experienced prior repricing cycles. It suggests that during these periods, price movements can seem chaotic, even though underlying structural patterns may still be present. According to the briefing, identifying those patterns requires attention to indicators beyond price charts, including measures related to scarcity. One indicator highlighted in the briefing is arbitrage. The report defines arbitrage in this context as the presence of price differentials for the same commodity across different markets. It states that when silver trades at a lower price in one major market and at a materially higher price in another, that difference represents a pressure imbalance within the system. The briefing emphasizes that such imbalances do not remain static and must eventually resolve, either through price convergence or through disruptions within market infrastructure. The report notes that while specific numerical values are not required to understand the implication, the existence of a noticeable premium paid by overseas buyers indicates continued demand for physical silver. According to the briefing, this behavior also suggests that supply conditions are not fully relaxed. The report states that under conditions of ample supply, metal would move freely between markets, premiums would narrow, and significant price differentials would not persist. The presence of sustained premiums is therefore presented as evidence of tension within the supply-demand balance. The briefing further contrasts the flexibility of paper markets with the constraints of physical markets. It states that paper markets can reflect opinions or expectations rapidly, while physical markets are limited by the availability and movement of tangible material. According to the report, when these two market layers send conflicting signals, the divergence is not permanent. The briefing characterizes arbitrage as one of the mechanisms through which market narratives are eventually forced to adjust to underlying conditions. The report explains that expanding spreads tend to attract capital seeking to exploit those differences. As capital moves toward arbitrage opportunities, it applies pressure that can realign prices across markets. The briefing suggests that focusing on these structural processes provides a clearer view of market dynamics than focusing solely on short-term price fluctuations. It describes this approach as observing the market's underlying mechanisms rather than its surface-level movements. Beyond scarcity, the briefing identifies trust as another central theme. It states that confidence in financial commentary and forecasting has been eroding due to what it describes as the widespread presentation of certainty in uncertain conditions. The report outlines an approach that distinguishes between what is clear, what is likely, and what remains uncertain, emphasizing that future outcomes cannot be known with precision. It frames this distinction as a methodological choice rather than a prediction. The briefing then outlines several macroeconomic conditions that it describes as observable trends. These include continued expansion of debt, more aggressive trade policy actions, ongoing shifts in supply chains, persistent inflationary pressures, and gradual erosion of currency purchasing power. The report characterizes these developments as arithmetic outcomes of existing conditions rather than speculative theories. It states that when such arithmetic constraints are not addressed, they tend to manifest later as broader financial stress. According to the briefing, attention has increasingly focused on the scale of sovereign debt, which it describes as reaching levels measured in trillions. The report notes that such figures are widely discussed within financial circles and characterizes them as indicative of systemic strain. It further states that political responses to such strain often emphasize narrative management rather than direct resolution of underlying financial imbalances. The briefing contrasts this with bond markets, which it describes as being primarily concerned with repayment risk rather than political messaging. The report explains that when repayment risk increases, capital demands higher compensation, and this adjustment influences interest rates and asset valuations across multiple sectors, including equities, real estate, and commodities. The briefing presents this as an interconnected process rather than an isolated development. It states that remaining passive during periods of systemic repricing is one possible response, while other participants choose to monitor and measure evolving conditions. As the briefing continues, it introduces a discussion of technological change, specifically referencing blockchain technology. The report states that blockchain is often associated in public discourse with speculative digital assets, but it frames blockchain more broadly as financial infrastructure. According to the briefing, blockchain represents a shift toward programmable and trackable financial systems. The report emphasizes that understanding this shift is relevant for interpreting policy direction and regulatory developments, regardless of individual views on the technology itself. The briefing states that major assets are monitored not for ideological reasons, but as indicators of liquidity movement. It characterizes liquidity flows as early signals within financial systems. At the same time, the report cautions against equating the presence of digital assets in macroeconomic discussions with the displacement of existing systems. Instead, it describes current developments as a period of public experimentation that historically has tended to precede regulatory responses. As the briefing moves deeper into its analysis, attention shifts from broad structural themes to how those conditions translate into actual market behavior and decision-making. The report emphasizes that information alone is not sufficient unless it is paired with a disciplined process. According to the briefing, An effective research framework serves two primary functions. First, it narrows a wide universe of possibilities down to assets that are realistically investable. Second, it assigns appropriate weight to risk, treating risk assessment as a core requirement rather than an afterthought. The briefing states that market participation without such a framework often resembles chance rather than strategy. It describes a deliberate effort to distinguish between quality assets and speculative positions by evaluating several factors simultaneously. These include balance sheet strength, exposure to jurisdictional risk, operational leverage, and sensitivity to changes in the underlying metal price. The report notes that not all companies associated with silver respond in the same way to shifts in the market, even when the commodity itself experiences significant movement. According to the briefing, some companies hold strong physical assets, but carry unfavorable capital structures that limit their ability to benefit from higher prices. Others may present well-designed promotional materials while lacking consistent operational execution. The report also notes that certain firms identified as silver focused derive a substantial portion of their revenue from base metals rather than silver itself. These distinctions, the briefing states, become increasingly important during periods when the market transitions into a new pricing regime. The report characterizes this evaluation process as methodical rather than dramatic. It emphasizes that careful classification and verification are essential during volatile conditions. According to the briefing, such work is often viewed as tedious, but it is presented as necessary for aligning exposure with actual market dynamics rather than surface-level narratives. The briefing then addresses a key question it anticipates from market participants. If silver is experiencing genuine scarcity, the report asks, why does the price not already reflect that scarcity in a straightforward manner? The briefing answers this by explaining that the silver market is not a single, unified structure, but rather a collection of interconnected layers. These layers include paper markets, physical transactions, futures, options, inventories, refining capacity, logistics, and policy environment. Each of these layers, according to the report, operates on a different timeline. The briefing states that paper markets can adjust pricing within seconds, while physical market pricing often adjusts over weeks. Mining operations, it notes, respond over quarters, and policy responses typically lag until pressures have already intensified. The report explains that because these layers move at different speeds, price behavior can appear erratic or disconnected when, in reality, the system is gradually reconciling internal imbalances. According to the briefing, this mismatch in adjustment speeds is responsible for sharp price movements that may seem irrational to observers focused on a single layer of the market. The report stresses that these movements are not random, but reflect different components of the system catching up at different times. It describes this as a structural feature of price discovery rather than a failure of the market. The briefing then turns to what it identifies as one of the most common sources of loss during such periods: emotional decision making. It states that during price discovery phases, market participants are often subjected to rapid price swings that alternate between reinforcing confidence and undermining it. According to the report, this environment places sustained pressure on attention and patience, encouraging frequent monitoring and impulsive responses. The briefing states that this dynamic benefits the broader system by extracting participation through exhaustion rather than through informed exits. To counter this, the report emphasizes the importance of focusing on process-driven indicators rather than reactive signals. These indicators include pricing spreads, physical premiums, inventory-related developments, policy adjustments, and observable changes in corporate behavior such as hedging practices, financing decisions, capital expenditures, and production guidance. According to the briefing, these real-world indicators provide earlier confirmation of shifts than popular narratives or short-form digital content. The report states that if an underlying thesis is incorrect, contradictions are more likely to emerge first in physical supply conditions or corporate disclosures rather than in online commentary. The briefing then references an additional element from the report released in late December, which addressed one country's relationship with silver. While the briefing does not characterize the article as speculative, it describes its tone as cautionary. According to the report, the article emphasized that silver should not be viewed solely as an industrial input, but also as an asset with historical monetary characteristics. The briefing states that nations with prior experience of currency instability tend to maintain awareness of the role that tangible assets can play during periods of financial stress. It suggests that when strategic demand for silver appears at the national level, it may reflect preparation or policy considerations rather than cultural preference. The report frames such behavior as deliberate rather than symbolic. Expanding on this point, the briefing introduces a historical reference to illustrate how resource imbalances have previously created pressure between economies. It notes that in earlier periods, disparities in silver flows were not merely academic concerns but catalysts for coercive actions. While the report does not claim that historical outcomes will repeat in the same form, it highlights a recurring relationship between resource concentration, imbalance, and systemic tension. According to the briefing, modern manifestations of this pressure may not resemble historical conflicts directly. Instead, they may appear through export controls, supply chain consolidation, refining dominance, or sourcing rules that influence access to critical materials. The report emphasizes that these mechanisms shape how resources are allocated within the global system, even when they are framed as cooperative or regulatory measures. The briefing then connects this strategic perspective back to silver's role in contemporary economic priorities. It states that silver is a key component in efforts to electrify, digitize, and automate economic systems. These transitions, according to the report, increase reliance on specific materials rather than reducing it. The briefing emphasizes that metals cannot be produced on demand simply through policy declarations, and that physical supply constraints remain decisive. The analysis then turns to the relationship between technological advancement and material demand, specifically referencing artificial intelligence and robotics. The report states that while these technologies are often presented as primarily digital, their deployment requires substantial physical infrastructure. According to the briefing, this includes power generation, semiconductor production, hardware manufacturing, and global logistics, all of which depend on reliable access to raw materials. The briefing challenges the notion that technological progress reduces dependence on metals. Instead, it states that increased automation and electrification often intensify material requirements by expanding throughput and system complexity. Within this framework, the report positions silver not as a legacy material, but as a potential bottleneck in future supply chains. The briefing is careful to note that it does not present guaranteed outcomes or definitive forecasts. It outlines scenarios rather than predictions, stating that certain conditions would strengthen the case for upward repricing. These conditions include continued debt expansion, further weakening of currency purchasing power, sustained industrial demand, and policy measures emphasizing resource security. The report also notes that divergence between physical premiums and paper pricing is a signal that warrants attention, particularly if it persists or widens. As the briefing enters its final section, the focus narrows to practical conclusions drawn from the conditions already outlined, emphasizing discipline, observation, and restraint rather than urgency or speculation. The report reiterates that the objective is not to overwhelm with excessive data points, but to isolate a small number of signals that consistently reflect real-world market behavior. According to the briefing, clarity in complex environments comes from selectivity, not volume. The report first addresses the influence of artificial intelligence, generated financial content on decision-making. It states that such content has become increasingly prevalent and visually persuasive, but cautions that it should be treated as a reference point rather than an authoritative source. The briefing emphasizes that reliance on automated or synthesized commentary without verification increases the risk of reacting to incomplete or misleading information. It describes this as a structural vulnerability in modern information consumption rather than a temporary trend. The briefing then returns to arbitrage and physical premiums, reinforcing their role as direct indicators of market conditions. According to the report, when buyers consistently pay higher prices in physical markets, those transactions represent actual capital commitments rather than expressions of opinion. The briefing characterizes this behavior as a form of market validation, noting that physical premiums reflect willingness to exchange currency for immediate delivery of material. It states that such behavior constitutes a measurable signal within the broader pricing system. The report reiterates that divergence between physical and paper pricing does not persist indefinitely. It explains that the system must eventually reconcile these differences either through price adjustment, supply reallocation, or structural disruption. The briefing does not assign a specific timeline to this process, but emphasizes that prolonged divergence increases pressure within the system rather than reducing it. The analysis then revisits the transformation of financial infrastructure, particularly the gradual integration of blockchain-based systems. The briefing states that regardless of public perception, these technologies are increasingly being incorporated into policy discussions and financial frameworks. It describes this shift as part of a broader effort to modernize financial rails by increasing traceability, programmability, and administrative control. The report emphasizes that understanding this infrastructure shift is necessary for interpreting future regulatory changes, even though the briefing does not speculate on specific outcomes. The briefing next addresses positioning and risk management. It states that intentional positioning requires distinguishing between asset quality and speculative exposure. According to the report, this involves tiering assets based on operational resilience, financial structure, and sensitivity to commodity pricing. The briefing stresses that emotional responses to price movement undermine this process, particularly during periods of volatility. The report notes that emotional decision-making is often driven by constant exposure to short-term price changes. It describes how frequent monitoring of price charts can amplify stress and lead to premature exits or reactive entries. According to the briefing, maintaining focus on predefined process signals reduces the likelihood of such outcomes. These signals include physical market behavior, inventory trends, policy developments, and corporate actions that can be observed independently of price fluctuations. The briefing emphasizes that these indicators serve as early warning systems. It states that if an underlying market thesis is incorrect, discrepancies are likely to appear first in these areas rather than through headline-driven narratives. The report frames this approach as a method of verification rather than prediction. The analysis then turns to trade policy, specifically referencing the use of tariffs. The briefing states that tariffs are often employed as tools to influence trade balances, but notes that they do not eliminate inflationary pressures. Instead, according to the report, tariffs tend to redistribute costs across supply chains. This redistribution affects where goods are produced, how supply chains are structured, and who ultimately bears increased expenses. The briefing explains that supply chain relocation introduces additional costs, including infrastructure investment, logistical complexity, and regulatory compliance. According to the report, these costs are absorbed somewhere within the system, often by end consumers. The briefing presents this as an observable economic outcome rather than a theoretical claim. Returning to the broader theme of hard assets, the report states that in an environment characterized by currency dilution and fragmented supply chains, tangible resources do not require extraordinary conditions to remain relevant. It emphasizes that time, rather than immediate price movement, is often the determining factor. The briefing characterizes systemic adjustment as a gradual process that unfolds incrementally before reaching a visible inflection point. The report warns that such inflection points are rarely announced in advance. Instead, it states that adjustments tend to accumulate quietly before manifesting abruptly. According to the briefing, widespread attention typically arrives after early positioning opportunities have already passed. The report does not suggest a specific timetable, but emphasizes the importance of monitoring transitions in public narrative. One such transition identified in the briefing is a potential shift in how silver is publicly characterized. The report states that silver is often described as outdated or secondary, but notes that narrative perceptions can change when strategic importance becomes more widely recognized. According to the briefing, once such a shift occurs, decision-making windows may compress as broader participation increases. The analysis reiterates that preparation differs from reaction. It states that participants who act under pressure often accept unfavorable conditions, while those who prepare in advance retain greater flexibility. The briefing emphasizes that this distinction is procedural rather than predictive. As the report continues, it issues a caution regarding market behavior during volatile periods. The briefing states that volatility can be used to discourage sustained engagement by creating fatigue. It notes that rapid price changes, combined with conflicting information, increase the likelihood of overtrading. According to the report, maintaining consistency in observation and execution is a countermeasure to this dynamic. The briefing again underscores the importance of monitoring specific factors. These include pricing spreads, physical premiums, policy signals, and corporate decisions. It states that these elements collectively provide a more stable reference framework than price charts alone. The report emphasizes that this framework remains applicable regardless of short-term market direction. The analysis then introduces an additional operational consideration: producer behavior. According to the briefing, hedging practices among smaller producers can influence outcomes for both financial institutions and shareholders. The report states that when production is heavily hedged, pricing upside is limited, while unhedged exposure allows margins to expand alongside rising prices. It presents this distinction as a factual relationship between hedging strategy and price participation. The briefing also highlights jurisdictional risk. It states that asset quality must be evaluated in conjunction with political and regulatory stability. According to the report, a high-quality resource located in an unstable jurisdiction may face sudden disruptions, while a smaller resource in a stable environment may retain greater long-term value. The briefing frames this as a risk management consideration rather than a valuation judgment. As the report approaches its conclusion, it states that future monitoring will focus on identifying which constraints tighten first within the system. These include inventory availability, refining capacity, and policy measures. The briefing emphasizes that changes in these areas often precede broader market adjustments. The report concludes by reiterating its central message. It states that understanding market structure requires attention to underlying mechanisms rather than surface-level movements. According to the briefing, price charts reflect outcomes, while physical markets, policy decisions, and operational behavior reveal causes. The briefing emphasizes that sustained focus on these elements provides a clearer view of evolving conditions. With that, the briefing closes by reaffirming its commitment to tracking measurable signals and maintaining a disciplined approach. It ends by emphasizing calm observation over reaction and preparation over impulse as the market continues to navigate a period of adjustment.